Yeah. So in the short run, people are just sucking up the tariffs.
Seems to be the case, with the exception of like the airlines, who are a bit more economically sensitive. Nobody really, I think, changed their outlooks that much. It was sort of like, let's wait and see. And nothing really has changed like that much. Obviously, the steel sector's had some very specific things, but they've been dealing with tariffs for a long time. What we haven't seen, I think that the real critical thing that I think I'm looking at are these changes in capex. Or where is long-term capital going as opposed to, all right, in the short term, we were a 15% margin business. Now we're just going to be 14 because we had to pay a little bit more to import product. I think that's sort of going on. But the rewiring of the supply chains, no one's bought in wholesale. And like, look, there have been lots of companies that have made announcements about we're investing more in America, but a lot of it was things that were already being done or stuff that I'm not sure I could take that
Window dressing. Yeah. But if you go from a 15% margin to a 14% margin business, you survive. And I sense that's how we've operated so far. But then, I'll play devil's advocate and let you stay away from the explosions. But if you take the employment numbers last week, and if we just presume for a minute that they're no better or no worse in terms of construction than they've been over the last decades, right? What we've been dealing with. You look at that and you say, well, that makes sense, right? It does make sense.
Yes. The hesitancy to hire and just with the uncertainty, like, do I want to bring somebody on board right now? I guess it's kind of a similar thing to CapEx, right? You're making a commitment to employees. And there are ramifications of doing it. And I think companies maybe are just being a bit more hesitant on that. And the shorter term, the OpEx things are just kind of being managed a little here, a little there. Inventory to become a big focus.
Inventory replacement has got to be more expensive. Just that's mathematics.
Yeah. And maybe we deferred the need to do that, right?
For as long as possible.
Liberation Day wasn't the end. We got a deferral, and then taco, Trump always chickens out, became a thing. And in a certain sense, to your point on markets, maybe it's become a self-fulfilling prophecy. A thing that they're hoping that like he really does chicken out and this doesn't last, and you don't want to look like the fool of someone who invested millions or billions of dollars in something unnecessary. And we had some companies do that during COVID.
Right.
And no one wants to repeat that. So I think there's this hesitancy and maybe, look, I'm not spending most of my time dissecting BLS numbers. There are other people who do that for a living. It is, one potential explanation for what's going on. But the thing is, we need a time series, right? And this is all new. And we're trying to have a thesis and see how it plays out.
So let me just pull the lens back a little bit. Yeah. Whether or not the BLS data is any worse or better than it's ever been, let's just, for purpose of argument, say it's status quo. Throughout your career, and I want you to tell me about how long that's been and what you've seen change, but you take this data as input and you expect revisions and you look for trends.
Yeah. Well, I mean, like, certainly, let's just say in my, call it 27-year career at this point, the post-business school career that I've been been through, and, that my first month out of business school, long-term capital happened, Russia defaulted, sort of, welcome back. Didn't you want to do this kind of thing? All that stuff happened. But even, at a time where, we're some of our old friends, like in small and mid cap world, those businesses are dependent on a couple things. It's consumer spending and how big companies spend money. Mm-hmm. And, somebody's CapEx is another company's revenues, and one person's spending is another company's like revenues and things like that. It's not sure where, other than in data centers, where the big CapEx dollars are coming from, or things related to the data center AI trend. And that's some, serious things that are going on. And that's the power business. But apart from that, it's hard to put your finger on who's running out and throwing big dollars around towards people or physical goods.
From where you sit, let's talk about what you do
Yeah.
now and the focus of Third Bridge.
Yeah. So, Third Bridge really has two businesses. The one a business we call Connections connects institutional investor clients with experts on topics. And if you want to know about something specific on data centers, we will find you that expert. But we also have another product called Forum, which we call our content business that I oversee. And what we're doing is I've got a team of analysts, about 50 people globally, and we interview these experts. And we're anticipating the questions that our institutional investor clients would have.
Valuable
And,
service.
we're trying to think like investors, and we serve public equity investors, credit investors, and private equity firms. So we're covering the entire capital structure of these interviews. And we'll do things from the really big picture stuff, like what's happening with shipping as an example, and how are tariffs, impacting trade routes, that thing, down to really micro things like, does Greenland have rare earth minerals that are worth pulling out of the rocks, there, and what are the implications, who might benefit and how much things like that cost. So we're serving a lot of different things. We're talking to about 900 experts a month. As I said, it's a global operation where we've got people in Shanghai, Hong Kong, Mumbai, New York, Dallas, London.
And this is all in a library now, right?
Yeah.
And are you now finding new tools such that that library can be translated into every language you need for distribution?
Yeah, I mean, the language, I guess I should also throw in, we have Tokyo as well, sort of thing, for a little over a year. The language part we haven't really done, although we do interviews in Mandarin and Chinese and translate them into English. We haven't gotten so much demand that we're translating English content into other languages yet.
It's
we'll
coming,
see.
though, and the ability to just, I know YouTube is testing tools where it's almost automatic.
I'm sure we're going to explore it. It hasn't gotten to critical mass. Like, sometimes I think this comes more from the private equity side, and makes sense that interviewing experts in European languages, if we had the ability to potentially do that, but the analysts running the calls themselves would have to speak that language and maybe, translate.
Complicates things a bit.
Yeah, it does, but we're always looking where the interest is from the investor clients, and trying to anticipate that. So we've made an effort in the last couple of years to ramp up what we're doing in Japan.
Interesting.
And it's gotten a lot of traction, so I would say, with clients. It's been a hot market.
Well, the framework has changed in Japan. I mean, you went from a negative interest rate environment to mildly positive.
Yeah. Sure.
It took a long time, but there's been a big move.
Yeah. I don't know. It has. And then when it happened, it really garnered some attention from investors. So we've added that. We cover a lot of different things, like different industries and in different geographies, and sometimes these things make more sense to cover in one geography versus another. A geographic question as opposed to an industry question. So we do lots of different.
Yeah. So before we dive into rails and rare earths and these things, let's take a very top-down approach. You speak to experts, you speak to investors. Let's talk tariffs for a second.
Yeah.
Forget about the action, but what is the view on tariffs? As I mentioned earlier, I grew up in a world where tariffs were straight up a tax, almost exclusively paid by consumers, eventually.
Yeah.
What do folks think?
Well,
forget the hype, forget the politics. When you're talking to people who do this for a living, what do they tell you behind closed doors?
Well, I'd say that, the world that we grew up in, right, was that was something that was tried in the 90s and it didn't work, and it's just going to stay there forever, save for some special case industries like steel, or things that were deemed national security issues like steel that's come up in the past, right? Trump won, and then Biden, this was the thing. But in general, globalization was the big trend, and open markets benefit everybody, and that's started to change over the last 10, 15 years in people's, view on it. Look, as far as tariffs, the first point is nobody really knows what Trump really thinks or means, and it makes it hard to invest. Okay?
You can't price it.
It's, thing, and it's like, is he negotiating or at starting here in order to strike a deal here? So while there was a lot of, let's say, post-election through the first quarter of like, oh, what do you think this might mean? It frankly was just guesswork, and I don't think anybody was, quite as serious. And I think what we're hearing now, and I think something that we've always focused is on supply chains. And how does this company or industry have to change its supply chains if something like this happens? And then who is better positioned, who is, going to struggle, and what they're going to have to invest in order to compete. And the GDP print was out, sort of recently, and like you never really had to pay that much attention sort of the end of it, the old textbook C plus I plus G plus X minus N, that's GDP. That front running of imports in the first quarter had a big, negative impact on GDP, and some of that got reversed. But we're spending a lot more time. We're doing this anyway, and the clients want to know is like, okay, how does this company source its materials or deliver its goods to the end customer, and how could that change?
Right. So you're using data to price different facets of risk.
Yes.
You're diving deep.
Yeah.
Let me take a step back again and ask, of the experts, the investors you speak with, is there a rational argument that you see that says the current policies could be beneficial for global trade or the U.S.? And I know that we're talking, let's not talk 6 months. Let's talk, 3 years to 20 years.
Yeah.
Is there an argument that this is a good thing to do for global trade or the U.S.?
Well, I think the argument for the U.S., and let me be clear that I do not subscribe to this view, is that trade is a much smaller portion of our overall economy than most other big countries in the world. And if we, kind of lump Europe together, China, again, we rely on it less, and we're like a big market unto ourselves.
That makes no sense, Pete.
It is an argument I just don't buy it. Okay.
So let me ask again, is there anything you hear where it says, all right, maybe we've been looking at this wrong for the last, 20 years. And let me posit. I remember when the first Honda was imported into the U.S., and it was a little tiny one that 6 of us on a wild night picked up and moved onto the sidewalk off the curb. That's how light it was. And, little rubber around the window. From that point on, we underinvested in middle America. We didn't prepare people for new jobs, retooling.
Yeah.
And it's been bad for us we all know, understood. So anything that could be done to improve upon that, hard to argue against. But I've yet to hear an argument that says, this is a really good idea.
Look, I'm someone who believes in competition, and competition makes people better. And I know what happened to the auto industry in the 80s as the Honda and other Japanese cars came in, and maybe the initial reaction wasn't the right one. But we have a better equipped U.S. auto industry, let's just say on December 31st, 2024, maybe than we ever had.
With a global supply chain, though.
Yeah. Yeah. The supply chain, we can make cars in this country that are competitive and stuff like that. But it was like, frankly, we're making cars that were just too big, and look, sometimes we fight the last battle, and retooling industries will take a while. But,
and take a while is what? You look at CapEx cycles.
Yeah.
What is that? 3 years, 5 years?
Well, look, it really kind of depends on the industry, that you're looking at. But think about now, the return on the money is another sort of question. But nobody really took Tesla that seriously. Here's some crazy guy with a car that only rich people can afford to buy the $90,000 Model S. And then sometime was in 2018 or 19 when they figured out they could start manufacturing these cars.
Yeah, he figured something out.
There were a few problems. And every EV maker or every automaker was now being questioned by shareholders. what's your plan to compete? Here, because here's a guy that people doubted seriously, and now he's delivering cars, and now he's telling people that he's going to have a $25,000 EV. What's your response? Ford, GM, BMW, Volkswagen, everyone came up with better EVs. Frankly, now
Innovation, entrepreneurship, all of that.
How much of this, was right and just sort of, overcompensating for underinvestment over time. Obviously, that's sort of thing that is going to plan. And we've seen some of the write-offs or the failure to get to profitability. Some of it, look, just the real world of COVID and stuff got in the way. But having some portion of your portfolio dedicated to EVs is probably a good use of capital, and not just seed an entire market to Tesla.
Right. So back to the question, though. This happens over years.
Yeah.
It's not quarters.
Yeah. And I think, just more broadly, I think we're really 4 months into this tariff. Nobody really knew what was coming out on Liberation Day. And then people went, oh my God, this is what it's going to be. And I think, look, it's hard to be on the board of a big company that is multinational. Where do you want to put capital? And even then now, say if you're an American company showing up in a country hey, we want to invest here, I don't know how welcoming people are going to be these days, given all that has gone on and the threats and things like
that. I can tell you, so you have the data, but I've been on the ground at the Port of Long Beach and Port of LA, and things have definitely changed.
Yeah.
There's all the uncertainty that you would expect, but things have changed, and I wouldn't say that the attitude is more positive. But, that can flip the other way in no time as well. But there's something going on. So with that, talk to me about rails and shipping volumes and what you see. There's some consolidation going on in the rails. What do you see there? How does that fit into this, both short and long term? Seems like a big deal to me.
It is a big deal. It's a very big deal and probably necessary, but the regulatory questions are still, out there. But if you want to even roll back 25 years, rails were not a great place. Investors hated them. Service was terrible. Something had to change. And then there was the rise of precision railroading became an important factor. And you had your first wave of consolidation. This is where Bill Ackman made a whole bunch of money on this trend before he was really rich.
And vocal.
And what, in Canadian Pacific, and that competition spurred all these railroads to become more efficient with their capital, more reliability, better service for customers, and made the American economy better. All around, no matter what, rail was a viable option, and this went on for basically 2 decades. Two things have, I would say gone on, kind of more recently. It was one, pretty much everything, the consolidation trend ended, and two, the benefits of precision railroading came to an end. Is where the incremental improvement from improved operating ratios is going to come from is a little hard to identify at this point. And then, trucking did start to gain share as it's lower capital to build a truck than it is to build a new rail network. There's some replacement cycles and stuff, but kind of the rise of fulfillment of .com or more e-commerce and real-time transactions has been a benefit to trucking industry. I just think kind of we're in this post-COVID of too much truck capacity has sort of bled into some share gains and some cost cut, making trucking more cheaper, and that's been putting pressure on the rails. And now the next solution is this giant merger of Union Pacific and Norfolk. Everything from the experts we've talked to is that this is going to have a high bar, from the regulatory point of view, and there may be a significant amount of divestitures in order to make this happen.
And the argument for lack of consolidation would be monopolistic competition.
Even the origin of the industry. I think this is the one thing that the Biden and Trump administrations kind of agree on. And people have pointed me to J.D. Vance's comments in the past that he agreed with Lena Khan on certain over consolidation thing in the industry, and we're gonna put this to the test, right? Like right away. And how does this benefit consumers? And it's gonna be hard to see.
Does it benefit consumers? Let's put regulatory aside. If you're sitting back as a smart guy planner, kind of makes sense to have 2 or 3 nationwide rail systems that operate efficiently, doesn't it?
Could. I don't know if we're going to need a national champion, in order to get this kind of.
So let's stay on that then for a second. So if something comes into the Port of Long Beach,
yeah,
I presume most of it goes on a truck, as opposed to onto a rail car.
Depends on where it's going. Longer if it's got to get to the middle of the country, it'll go by rail.
And
then from there, right? This is the rise of intermodal, right? You can put the container that goes on, can go on a train, and then when it gets to the terminal, it can go on the back, on the back of a truck, right? As it gets broken down and then spreads out from there.
Makes sense. So do you buy the service companies, the manufacturers of the rail cars and all of this?
Well,
or is that played out?
That can be pretty cyclical. It's an industry that hasn't added a lot of capacity. I think the last time that there was a boom in demand for rail cars that didn't last very long was in the 12 era, when oil production in the United States really started to rise quickly, and it was easier to ship the crude by rail, or it was quicker than building pipelines, than building giant pipelines.
That's incredible when you think about it. Yeah.
Eventually, all this stuff, the pipelines got built, or some kind of way around it occurred. But since then, it's been pretty quiet. But it's still early. But if you're a rail car manufacturer, now instead of selling to like 6 giant customers, it might just be 5. Your pricing power can be limited by this consolidation, and they're probably going to be the ones who push back on this, potentially.
At this point, does civilian rail share those lines?
They do. Amtrak isn't exactly the most efficient, sort of thing, but they own some track, up here in the part of the country that I live in. They do. But
bull case that can be made based on civilian rail sharing tracks.
It doesn't get a whole lot of political support outside the Northeast. It's people do like their cars in this country. They want to drive. So that's unlikely, sort of get it. But, Amtrak, basically buys capacity from CSX and Norfolk Southern and
that's really what I was asking.
For those long haul routes. But for passengers, air is a pretty efficient way to travel in this country, right? You've got long distances there. Airports, airlines always get funded, always. Planes are available. So
does anybody make money in airlines?
Say again?
Does anybody make money in airlines?
Yeah, they do. I mean, it shifts over time, right? I mean, it's been a model, but nobody went bankrupt during COVID. Even they had like a 90% drop in passenger, the number of passengers flying on planes. And look, the government stepped in to backstop things. But I think maybe one of the more remarkable statements, we're not, I don't know if we're going to test it, but I said earlier, the airlines were the companies that withdrew their guidance. United was the exception. And United said, we're going to stick to our guidance, but in a recession scenario, we're going to make $4.50 to $6.50 a share with revenues down 5%. That's like, wow. Normally an airline loses money in a recession. This is something different. And there was a lot of cost cutting and saving that went on at airlines. And it was only, last year that we saw Spirit go bankrupt. Nobody went bankrupt because, we had a drop in passenger traffic.
It really is a pleasure to fly these days.
Yes. Well, look,
there's that.
The in America, we started a few new airlines during COVID, Velo and Breeze.
Sure.
Some of these are out there in California, but people are always willing to try and back airlines. And I think maybe if there's one thing I learned from COVID, maybe as an investor, is that the desire to travel post-COVID actually got stronger.
I read your piece.
I think people just sort of, had to like, boy, I don't want this to happen again. I don't want to miss my opportunity to go to whatever that place was. And the demand really has come back. Business travel, that overnight flight to Europe just to go see one client, in the afternoon and fly back later that day. That sort of stuff got displaced by Zoom.
Well, it's what we're doing now. I mean,
Yes.
I think of the travel I used to do when we met.
Yeah.
It was 4 days a week.
Yeah.
If we had these systems, it probably would have been cut by 75%.
But the leisure traveler is like come back strong. And I think that's where we've seen a lot of the capacity growth and people trying to meet that stuff.
So let's talk energy a little bit.
Yeah.
An area that you know a lot about. And I was looking through my decades of notes before we talked, and I realized that there's a company, LNG, that you and I talked about.
Oh, yeah.
That I had a question, you turned me on to it. It's 100 bagger since then.
Yeah. Yeah.
And not even assuming the worst. I mean, it was $2 to $3 a share when we were.
Yeah. I like to make the joke. I only know of 2 companies in my career that shorted their original business model and lived to tell the story successfully. And I'm like, Cheniere, the business plan was to import natural gas to the United States because natural gas here was too expensive and it was cheap overseas. And then that didn't work out because we discovered shale gas in this country, and now we're exporting it. And it's the biggest exporter, and it's been a wild success. They survived. I don't know if we want to talk about the survival story. And then I think of the other one, I think is, a little company called Amazon, right? I used to order books from them. And now why do I order books? I don't need them anymore. They invented the Kindle. Now I just read them. I read them electronically, and it's like the margins are better. So
and all of that. Yeah. But so 100 bagger, just to define, it's 100 times the money. Yeah. And I mean, it's 2003 is the year I was looking. We might have talked about even before that, but
yeah.
That's quite a bit. So with that and shale, what's really happened over the, let's say, last 2 decades is technological changes driving a lot of this. Yes. Right. And I'm not close to it any longer, but I presume the mapping technologies and all of this that were so revolutionary 20 years ago must be light years ahead at this point. Yeah. So just talk to me about that and what it looks like in discovery.
Well, I think the most important thing is that where I get excited, or always makes me excited, and back to our earlier topic on competition. And the price of oil and gas in this, in the world went up a lot in the 2000s when we were talking 2003, 4, 5, 6, 7, right? And some of that was driven by China, right? They went from an exporter to an importer in a number of commodities, and oil and gas were among those, and the prices took off. And smart people in the United States got to work. And rather than saying, we need to restrict this or do that, people got technologies that really, like 2 of them, directional drilling and fracking, that started in the 60s and got to work. And it wasn't perfect. And there was this guy, George Mitchell, out in Houston and his company was based in Houston, and he was doing a lot of stuff north of Dallas and kind of in the 90s. But really, as those commodity prices took off, they perfected or got close to perfecting how to extract oil and gas from those rocks. I used to drill into them and nothing would happen. They needed to be fractured. And this being America, we threw a lot of capital at it. And just to make it better and get down the cost curve. And while the natural gas market collapsed quicker, or the response was quicker, that allowed a company like Cheniere to now start exporting gas or change the model that they could see the abundance of gas. The effect took a little while longer. It's just the oil market was a lot bigger. And it really took till about 2014 that U.S. oil production impacted the global market. And then oil output in the United States peaked in 1973, and I think it went down every year except 2 until 2008. And then it started to reverse in 2009, and then, made an all-time high, I want to say 2014, 15, 18, 19, 20, 18, 19, and then again 2022, 23, 24. And it's been a remarkable thing that has really changed the dynamics globally in terms of how we're negotiating, with other countries, and the opportunity that the energy that the United States can provide, whether it's oil or gas and in what form, we can do that.
So just recap that for me in one sentence then. Where are we in terms of energy production, and what does it mean for U.S. industry?
Well, I think we're at a high in terms of volume. And in particular, I think natural gas is the most compelling part of it, that it is displaced coal. It wasn't President Obama or going after the coal industry. It was cheap gas. And any industry, whether it's power or petrochemicals or what Cheniere does, and exporting LNG, the United States is a great place to do it, because it's a super big natural resource that we have, and we're now exporting.
So now we have, I'm going to call them data centers being built.
Yeah.
I know it's not the vogue term, but whatever it might be. Is that the newest drive and demand for energy? It is, yes?
It is, for power. And when we first started talking, in the late 90s, right, this is where I go back. This is the last time we've seen this, was like everyone was getting on the internet, right? Or getting their home computer and plugging in. And it wasn't just going into work and turning on your computer. You were going home and turning on your computer to do your own personal internet. And people were spending more time. And you had the California energy crisis there in 2000. And there were some bad guys at Enron manipulating the gas market and stuff like that. There were the rise of these companies like Calpine, Dynegy, the independent power sector that saw this opportunity. And we built a lot of capacity, then. But then you had a recession and things slowed down, and the pace of the internet just kind of everything got a little bit more efficient. And we also implement the Energy Star program really kind of came into its own.
It's being taken apart now, isn't it?
Yeah. That's sad.
Different topic, but
air conditioners got more efficient, and the monitors and things like that. There were both supply and demand. I would say responses to that. I mean, all it seems it seems so long ago, and people I think kind of forgot about it. I mean, it was a crisis in California, that there wasn't enough power. Now these things do pop up now with extreme heat, and I'll say we've been pretty lucky so far in being able to provision enough power, because a lot of investment's gone on, just in the renewable side as well, as far as natural gas. But it is, if you just start connecting a few dots on these power centers, it's AI. These things are going to start to be needle moving 26, 27, 28, in terms of power demand, all else.
I mean, that's tomorrow, essentially. That's tomorrow.
And I think this is one of the more interesting things that we've seen sort of at Third Bridge, is sort of having more of a front row seat in what's going on in private equity than spending all my time in public equity, and that the demand for existing gas-fired power is through the roof. Because if you and I wanted a natural gas turbine, industrial scale, let's go start a utility or an independent power company,
sure.
Right? There are three companies that we would buy that turbine from: GE Vernova, Mitsubishi, Siemens Energy. Well, it takes us 5 years to get that turbine. So take a number, and in the meantime, let's buy one of these power plants from someone somewhere, and put it back to work. I mean, we're even talking about restarting 3 Mile Island, right?
Right. So let's dip into nuclear for a minute.
Yeah.
And large scale, small scale, realistic or no? I mean, I read your piece and I understand the regulatory element and
Look,
this, but
somebody said this to me about a different sort of technology, but I think it's, and I don't even remember which one. Nuclear is that dangerous intersection of PowerPoint and Excel where you can really hurt yourself. And the thing is, whereas, let's call it at peak shale, let's say, we had something like 1,600 drilling rigs in the United States. They were probably drilling a new well every other month. Now the pace is like quicker than each, sort of rig, but it was a lot of wells and a lot of practice. We just don't build that many nuclear facilities, whether it's big or small. We really haven't done it in a long time. We just don't have the practice in the US and Europe building these things. So the last one that came online in Georgia, the Vogel plant, right? It was billions over budget, years late. So yeah, it's up and running, and it's certainly helpful. And our experts tell us today that Georgia is a great place to build a data center because you got plenty of reliable baseload power.
So the idea of a backyard nuke or a neighborhood nuke or city,
I think,
way off.
look, Google and Microsoft and Amazon, they're all backing these companies, but I think that they're going to be looking for alternatives on these start dates that they've said to people publicly. And that's where you come back to natural gas. And a lot of what was built in the late 90s and early 2000s are what we call peaker plants. And they were, only there to work a certain portion of the year. When it got really hot, and everyone's running their air conditioning to, keep their computer cool and all that stuff. And they turn them on and they run about 40% of the time. Those assets are probably going to run something like 70 or 80% of the time, and maybe even more if these nuclear things don't happen as scheduled and the data center build out continues with what has been said publicly. It's nice to, have and the backing that you're getting from really big companies is encouraging to go out and try, to do this. But the technology people, just the practice, the engineering folks to get all this done. This is not that many people out there.
Is it an investable sector? And if so, are you buying the picks and shovels or the producers or distributors, or is it not investable?
Certainly investable. And I think that maybe to go back to think this is the incumbency. Having existing power, cheap baseload power is a good place to be, whether it's gas, nuclear, things like that. Look, for the time being, you're let's just say like a new scale, which is generally thought of, it's got the clever ticker of SMR for small modular reactors. They're not going to run out of money. This is America. We finance all kinds of things. It's when they get to the point in a few years where they have to demonstrate whether or not this will work at the cost and budget that's been laid out. That's where it starts to get a little dicey, I think, for investors.
So I suspect
it all looks good today.
Timelines are probably off. Yeah. It doesn't look so good then.
Yeah. If my business in 2030 relies on some small modular nuclear technology, I do want to be looking for alternatives, which brings us back to gas and established working power plants backed by cheap natural gas in the United States.
So if I were very bullish on SMR and I were looking in the private equity space, the smartest people you talk to there, what is the bull case? Is it just evolving technology, or is it there's got to be a real breakthrough here at some point, and we're playing around until we find it?
When you get past serial number and look, these are smaller things, so you're going to get more shots on goal, but you're going to come down the cost curve. And there's enough legitimate, well-capitalized companies, again, Microsoft, Google, Amazon, willing to move this along. And some of it had to do with their own climate goals and low emissions or no emissions, right? In the case of nuclear, that they'll see it through. And while serial number one might be, 10, serial number 2 will be 9, and serial number 3 will be 6, and we'll get down that cost curve at some point. Whereas in the past, I recall a lot of industrial technology never got enough capital and time to see it through.
What is a molten salt reactor?
The great thing about a molten salt reactor, or the most interesting thing maybe I said that I've learned in the last 12 months.
That was actually going to be a question I asked you. What's the most interesting thing you've heard or learned in the last?
I think that I've learned from one of our experts was the origin of the molten salt reactor was to fly planes, nuclear planes, in the 60s. It didn't work. Okay. That's a good idea. I mean, look, we have nuclear powered submarines, and that makes sense. To me, it's like, you don't want to have to be popping up for diesel and finding a port, like a gas station, all the time. Like have a reactor, but this was the original line. The idea that it would be safer, but I would put it in the subset of small modular reactors. Obviously, like a plane, or a nuclear submarine. It's right. It's one area. But this is something. There was a company called Moltex up in Canada that has tried this. But money is being put at this. But the original thinking of doing this was for nuclear powered plants.
Interesting.
But there were back to fracking or the rise of shale, right? Those technologies, as I said, horizontal drilling and fracking, that stuff started in the 60s. Usually what I would call industrial technology just doesn't fall from the sky. It's a breakthrough. We're dusting off old things, putting more capital and more effort into this. So Abilene Christian University is the center of the universe for this. There's something called NEXT. I think it's like NEXT. It's like nuclear engineering something. They got an institute down there. They got like $400 million from the government last year to go for it. We've talked to some people, so
it's
down
very
there.
Interesting tidbit.
What's that?
I said that's a very interesting tidbit.
It is. These are the things that we'll dig up. But this is what Google or one of the technologies that Google is backing, the molten salt reactor. I'm like, look, I credit to Google, Microsoft, Amazon. They're trying a few different things, and it certainly helps. And I'm not saying that like one type of reactor is going to win over the other. It's still a little hard to say that.
Yeah, you can only work with what you've got right now.
But it's a portfolio approach. And Microsoft is behind the restart of 3 Mile Island. You and I grew up with knowing what it is. And I went to school in Pennsylvania up the Susquehanna River. They're backing it. One of the things we haven't been able to find, where we're still sort of looking, it's like the only other place I know of in the world that is restarting shuttered nuclear facilities. It's in Japan. And they started this before Microsoft is paying Constellation to redo or restart 3 Mile Island. I want to know about what their experience is so far. They're a couple years ahead of us, what those challenges are. We'll get that done. We will find someone who can walk us through. But it's not, it's not like a car that's been kept in a garage.
Yeah, there used to be a little company called Energy Solutions that had, I think it was Type 1, if I remember, but shipment of waste and storage. Is that still I presume it's still a
I think they're still kicking around, if I'm not mistaken. Yeah.
But the idea in general of where do you store the waste, have we solved that?
We have not. But the number of nuclear power plants has declined from something like, it was like 120 at peak, and we're down to 92 now, and it's gonna start growing.
So that takes the pressure off a little bit.
Yeah. Look, and Diablo Canyon in California was going to close, and this is restarting utility scale nuclear. Is it really kind of a new thing? Like it is, because just the trend had been, we don't need it. Too expensive up front. But these facilities have lasted a lot longer, I think, than anyone would expect it, and generally they've been safer, than reliable.
Let me ask you to take a top down, a big view on the markets as we close. You're doing very bottom up research now, the real hardcore stuff, but you ran money for a very long time. Mm-hmm. So I know you watch the markets closely.
Yeah.
What do you think overall? Levels, valuation wise, just all the big metrics. What do you think?
Look, corporate earnings in the United States, by and large, have delivered. And I get, maybe if we were doing this time last year, we were probably talking about American exceptionalism, right? And the fact that the United States is growing faster than Europe, it's growing faster than China was post-COVID, and the pace of innovation, the wealth creation that was occurring was, propelling the markets to all time. The U.S. has managed, despite lots of things thrown at it, to power up. And now we're getting, I don't want to get too political, sort of on this, but changing, we're changing some of these things. And as we were talking earlier, like there does seem to be this hesitation on the part of corporates to invest long-term capital. You're not seeing major, I think, sort of new, bold investments in CapEx outside of the power sector, related
So
to
what does that mean in terms of this discussion?
But the near-term results have still been there.
But with that, Pete, there has been substantial multiple expansion, hasn't there been?
There has. For sure.
What's the S&P right now, plus or minus?
On a multiple basis, I'd have to go to
low 20s.
Look that up. But it's been
it's higher than historical,
and it's more tech and consumer oriented than it's ever been. Right? It's been skewed more towards the Mag 7, and these companies they are delivering. People do get a little panicky and edgy. Right? We would be talking about Facebook or Meta like a few years ago when they were throwing all that money at the metaverse, and now they're turning themselves into an AI company, and they're delivering what they've said, and they're meeting or beating expectations for the time being. I don't think anybody's at risk of running out of money or access to capital. And I think that's why we're, where we are. As far as the opportunity for new money into the market, people, what takes the multiple even higher? That's where I kind of struggle. The expectations are high in lots of areas, not just.
If interest rates drop by 100 bips or 150 bips, does that change the CapEx decision dramatically?
I think it would. That people would get more comfortable. That the market, sees that, hey, we're going to finance our deficits and growth is going to be there. The exception would be, right, the why. And if maybe that recession that everyone thought was coming in 2023 or 2024 finally does happen, and that causes rates to drop, we might have a different, view on what the market should be doing. But anything we see in the corporate results right now is like things are pretty good, and I think that's why the market's there.
So I cut you off when you said new money.
Yeah.
What are you doing?
Right. I mean, it's buying it Nvidia or whatever it is at these multiples can be a tricky thing, right? But the company does have a track record of innovation, and if you're willing, to really look long term and do a DCF and say the rates are going to come down, it's new. I mean, it's back to where we were. We both, started talking during the dot-com bubble, right? And it got crazy, and then, we overcapitalized it. It crashed, but then people figured out how to make money from the internet in lots of different ways. And maybe that's what AI is. There will be some reckoning, I'm sure, at some point. Is all this growth sustainable? What's really behind it? But these companies are the big companies. I guess I see less of a threat maybe from new entrants than what we were talking about during the time.
And final question: does the wealth disparity in the country and the health of the U.S. consumer start to factor in? Again, politics aside, if you just kind of look at the numbers and credit card balances and who's living paycheck to paycheck and all of these sorts of things, it's hard to make an argument that says for 50% of the population, at least, that they're healthier now than they were 5 years ago.
Yeah. Well, I think, the things like credit card balances, stuff like that are just getting, we've taken out the sort of all the distortion from the COVID era. And they're now getting back to, or above some of the trends we had been seeing like pre-COVID. And it is, concerning, but, the wealth disparity thing has been going on for decades. And I'm not sure that I'm smart enough to know in advance that where that tipping point is going to be. People do seem able to manage through it, not great. And I empathize with it, but employment, putting aside Friday's jobs, report, the unemployment is low by historical standards of anything we've been thinking of prior to the mid-90s.
So are interest rates by historical standards, was an interesting position.
So, but look, we're kind of dusting off all the old history, right? We started with tariffs, right? Something that we didn't think we'd have to think about again, because it was generally thought it was a bad idea. It didn't work. We're having to go back deeper into history, or as I said, industrial technologies from the 60s, and can they work today, and things like that. We're all going to have to be students again. So even though we got future technologies out there like AI, are there enough megawatts out there to power all this, and the supply chains to connect all this?
Thank you very, very much. And